can I just do a quick sound check? Can you just put Y in the chat if you can hear me okay? Okay, so a couple of people can hear me. So, okay, what this is today, this is an open house, which means it's just a free format. There's no webinar preparation for this. It's just free format Q&A. Now, I have obviously received questions by email, and I'm going to go through those questions first. If you want to put questions in the Q&A now, just put them in any time and we'll get around to them. Also ask if you haven't done the poll yet, just fill in the poll. So before we get started, I have to show you the disclaimer. You all know this, but also one thing to bear in mind is we've all got our own appetite for risk, our own risk tolerance, all got our own different account sizes. So just bear in mind if we do cover anything like position sizing, stop loss sizing, that tends to be a bit personal to our own accounts, and just to bear that in mind when you take it back to yours. Okay, so what we tend to do with these Q&A sessions, we do them every now and again. We get some questions on the email and then we get some questions in the room, and I expect the questions to generate more questions. So what I'm going to do is, as I'm going through each question, I'll keep an eye on the questions just in case there's one that's kind of relevant to the topic at hand. The first one is the current trade columns. Talk about the depth and sales tool. How does it refresh? Is it whenever it's traded each time a price level is hit? So let's just explain this one. It's actually the easiest question so far. So the current trades column is this column here. Okay, and it shows me how many sell market orders hit the bid and how many buy market orders hit the offer. The sell market orders there in pink and the buy market orders there in blue. Now, as you can see, it accumulates. Let me just bring up a slightly thinner market. See if we've got one that's going up and down. Right. Okay, let's reset that. So what you'll see as it goes down, it's repainting the numbers. And the question is, when do they reset? And this is kind of key to the way the current trades work. So you can see as it goes up, sometimes it'll actually reset and blank the number out, and sometimes it'll just tick up and accumulate. So the idea is it's supposed to show you what is trading this time round. Now, this time round, it doesn't really mean, it's trading at this price and it ticks down for a millisecond and ticks back up and it's no longer trading at that level. So what tends to happen, we see things like Iceberg orders, for instance, which it will be another question later. So you can see, we've traded 300 contracts into 91.50. And what often happens when you get an Iceberg order in there, you might see a bid for 500 and then 200, 300, 400, 500 trades, and you look at the bid and it's still 500. So what's happening there is they're still refreshing the bids. They're still increasing the bids as people to trade in them. So you might see 500 there, another 300 trades, and you still see 500 there, right? So they're refreshing. But what can happen sometimes is somebody can clear that bid. So if there's 500 there, they can clear that bid. Maybe they throw a sell market order 600 contracts. It'll clear that bid. It'll tick down through that bid, but that bid's set to refresh. So it'll tick down, and then the moment it's ticked down, it'll actually tick back up. And you'll see that a lot. You'll see it trade at level, tick down, and just for a moment, and tick back up. So when that happens, we consider it to still be trading the same level. So basically what we're saying is, if it leaves that price and comes back and trades it again later, then it'll reset. But if it's just kind of a momentary blip and just kind of leaving the area for a second, we want to kind of accumulate and see what's really, what's going to trade there in total. Now you can change the way that works. The clear trades timer interval, that specifies how many milliseconds do I have to leave a price before I'll reset it when it comes back. So any more than 2.5 seconds away from a price, it'll clear. Why is 2.5 seconds the magic number? There's no reason for it, really. There's other than just when I wrote the tools, designed the tools, just tested a lot of different ways of setting it up, and 2.5 seconds seemed about right, basically. I mean, if it leaves for more than 2.5, 3 seconds and comes back, it's really trading the level again. Okay, so that's the easy question. Next question. I'm a crude trader. I want to get your thoughts on the best of the Jigsaw tools to use with it, since it's a thinner market than the S&P. So far what I've noticed seems like reconstructed tape, auction vista and snapshot for stacking bids and offers, along with the current trade seems to be a good combination. Well, it really depends on how you're trying to trade. So let's just bring up the crude. And just 1 second. So one of the things that I tend to do with crude, if we just bring it up, right, so there's crude. So you'll hear me say that I'm a very big fan of correlated markets, that you don't see many traders trading just one market without looking at another. And I think crude is probably one of the exceptions to that rule, in that if I'm looking at crude, I tend not to bother about looking at another instrument. There's no great correlation with crude. It's correlated to the dollar, it's correlated to, other, it's correlated to gold sometimes, but that's really more of a dollar thing. It's correlated to natural gas, obviously. You could look at the different calendar expiries of crude. But, it all depends on what you're trying to trade. But this is the way I look at crude. And the things I'm interested in the delta, for shifts in delta. I'm interested in volume spikes. I'm interested when the volume really becomes excessive, like this area here. You see this volume spike. A lot of volume traded there. What price is that? That's at 58.23. And then the market turned down. So that's the kind of thing that I'd want to see on crude. The snapshot columns where we're pulling and stacking, I tend not to use those so much, purely because the market is kind of all over the place. So what I'm trying to do with this setup is just try and find momentum. So to look for volume spikes and then look for some momentum against those spikes. So I definitely, let's just check the settings on here. That seems a bit strange. Wow, that does seem a bit strange. We've got no large trades coming through. So I like to see the large trades on the recon tape, look for more than 10 contracts. I like the balance of trade because I mostly use that since I've entered a position. And really, I'm just looking for spikes and then some momentum. So crude's, there's lots of ways you can play crude. For me, it's good for momentum plays, and I think there's two big benefits of momentum plays on crude. First of all, you don't really have to do any prep ahead of the market open to decide to take a momentum trade, because you get momentum all over the place. There's a momentum move here. There's a momentum move here. It's a momentum market, right? So if you want to take small bites out of crude, you can do so with kind of very little information. The only thing you have to do is you have to not be like the deer trapped in the headlights, because if you can't get out of a position really, really quickly, when it goes against you, it's going to chew you up. So I would say for crude, you can use whatever you want, and it depends on your trade style. But for me, I really want to see, like a big aggressive move in one direction, and maybe some volume print, and then I want to see the market move against that volume. So there's no really right or wrong with order flow. I mean, I know a trader who can scalp crude for one tick, and it would seem like madness. Obviously, he's got very good commission rates as a professional trader, but it would seem like madness to most people to scalp crude for a tick, and he'll do that just using the dome. So I don't think there's a right or wrong answer to that. If you're trying to play pullback specifically, then I think the snapshot will help a little bit more, because you want to see a market coming down, and then after the market's been moving down, you want to see the sellers pull out of the way, and you want to see the bidders start to stack. So I can see using snapshot for pullbacks, but for me this is it. This is all I need. Just you have the circle tuner at about 4. If you have the circle tuner less than 4, you tend to get something like this, which is, to me, is not readable. The reason you get more circles when the tuner's low is because on crude, there's more of a disparity between low depth and high depth, right? So you can see low depth could be 30 contracts, 79 contracts, and high depth could be 104. And it's just, that's the way the tuner works. If you've got more of a disparity between a lot of size and a little size, then you'll get more circles. So we kind of just tunes that out a little bit. Okay, so let's go to the next question. Again, that was a fairly painless question. So like I said, there's no right or wrong with this stuff. It's just, if something seems to work for you, then it's okay. Okay, so icebergs. right, how do you spot an iceberg order using the snapshot and current trades? Okay, so everybody wants to trade iceberg orders and wants to trade absorption. And we'll look some more of that in a minute. But what I would say, if you're looking for icebergs and absorption, the one mistake you can make is trying to give yourself what we call a one rule trading strategy, right? So one rule trading strategy would be, I see absorption and I buy, right? And so that would just be, but that's kind of a bit silly, right? Because that's literally see absorption and buy, or see absorption and sell. That's almost like a moving average crossover. There's no context, there's no understanding where other people's positions are located. And it's like, when we first saw the heat map tools, somebody's talking about bookmap here. One of the problems when these heat maps first came out was the amount of people telling traders that you see large depth and you jump in front of it, right? And again, it sounds fantastic because it's a one rule trading strategy, but it doesn't work. Whenever you try and implement a one rule trading strategy, the market's going to make you implement more rules, okay? Anyway, so we'll just have a look. So I'm having some trouble seeing it. Once price got to there, it started to balance. Every time it ticked down, the bids kept stacking and price would tick up and then back down. Bids continue to stack into the order book. That is an example of an iceberg. So let's just have a look at how we see icebergs. Okay, so iceberg, very simply. Oh, okay, we got one here. So you can see this area here, right? We've got 1200. Let me see if we can take a snapshot of that before it goes. All right, it's gone. All right, that was great. Right, so what we could see there, we could see 1200 contracts on the snapshot, and we had about 300 contracts bid, and we had about 1300, whatever it was, traded. So basically, the snapshot here just tells me what's been added to the book since I've been at this level, right? So if it's an iceberg order, all it means is you trade a lot more than is displayed, right? So if I get to this level and there's 200 shown here, and I trade 1,000, I had an initial size of 200 and I trade 1,000, that's an iceberg. Because basically somebody or whatever, different people have added contracts to that level since we've been trading there, right? Now, on its own, it's not enough for a one rule trading strategy. If you had an upward market and you had an iceberg on the bid, then that is a two rule trading strategy, right? So you've already got an upward market, market's falling back, iceberg on the bid, then you've got a bit more reason to go in. Now we can see at the moment we've got, let's see what they're adding here. See if I can take a snapshot of that. Okay. Let's just let it trade a little bit more. Okay, so what we can see here, we've got 234 bid, right? So that's the size of the limit orders. We've got 409 have traded. And since we've been at this level, they've added 568 bids to this number here, right? That's all an iceberg is, right? It's all an iceberg is. So it just means the level where they wanted to buy, right? But they didn't want to show people they wanted to buy, right? Now that's different to when you see a really big bid. When you see a really big bid and a big white area on the Auction Vista chart, that means somebody wants you to see them, right? But it doesn't mean they want to buy, right? So with an iceberg, somebody wants to buy, but they don't want you to see them. When you've got a large bid below you or a large offer above, that means somebody wants you to see them, right? But it doesn't mean they want to buy or sell. So quite often, they'll pull out of the way when price approaches. And obviously one of the keys for that, for trading those scenarios, is to front run a large bid, is actually look for other people front running the bid so that you're not the only one. Because generally speaking, if you want to front run a bid, you're much better just watching the bids ahead of it and see if people front run that bid. And if they start front running and stacking the bids ahead of the large bid, you've got a much better chance of that trade working out. Okay, so That's an iceberg. It's not very complicated. It's literally somebody wants to buy or somebody wants to sell, but they don't want to show it, right? So as you trade, this number here just goes up and up and up as we trade. Now that number's going to go up and down, right? So it's 191, yeah, but nothing's traded. So it's just kind of going up and down at the level. Nothing's really traded, nothing really serious happening. But it's when you get the 7, 8, hundreds, 1,000, that kind of thing, that's when it becomes significant. And if you want to know, like, okay, well, what's the number I should look for an iceberg? You know, all you got to do is look at these numbers here and see if one looks exceptional. So if we traded now, we had an iceberg and there were 600 contracts, I'd say that's probably not relevant. If we trade an iceberg now and there were 1,500 contracts, I'd say, well, that's pretty relevant compared to anything else we see. So generally speaking, all of the size, if you want to know if something's significant, does it look significant? And the same with the bids. What you'll find with the bids, when you're looking for the big bids and the small bids, in a market like this where they're bidding 600, 700, 500 down here, they're not going to put like a spoof bid in for 780 contracts to make it the biggest there, right? That wouldn't be a spoof bid because it wouldn't draw your eye, right? So this bid up here, this offer up here, 1,300, that draws your eye, right? And you can see we've got the kind of highlight here for that. So that draws your eye, and that's what the spoofing, that's what they're trying to do. So when you're looking at the spoofing, are they actually trying to, is that really a spoof order, Well, they're going to make it look big. If it doesn't look big, nobody will notice it. So there's no spoofing, or they're going to put 800 in here and spoof the market. That's not what's happening. So if you're looking for flipping action and stuff like that, where people flip the market over, the start of it is to see something exceptional, something obvious. Shouldn't require a calculator to figure out. Okay, so that's icebergs. Now, just a word on absorption and icebergs. Okay, because a lot of people want to trade them. So just some kind of tips on what to do with trading them. So first of all, the iceberg, the best way to look at it, right, is if you have an iceberg or an absorption level, so maybe we're trading 500 or 600 contracts per level, and then we get to a level and we trade like 4,000 contracts at that level, right? So that's 4,000 people that have traded at that level, right? Now it might mean they're trying to hold the level. It might mean somebody's trying to hold the level, but they're going to get run over. But what it does mean is at that point, you should have a decent risk reward on any trade, because if the market moves down and somebody steps up and absorbs 4,000 sell market orders, if the market stops to pop up, the people that sold those 4,000 will need to unwind, right? So they're not going to just sit through a 50-point move up, right? So the point of the iceberg is, as the market moves up away from it, you should get a little bit of a pop, right? There should be a little bit of a break in the market. And when that happens, it kind of confirms that you're right. On the other side, if the market moves down through that level, and give it a couple of ticks, not just like one tick through, because sometimes, as I said earlier, they can pop the iceberg just because the computer didn't get enough time to refresh. A big order came in. So basically, if it goes through the iceberg, any trade you took because the iceberg is over. Yeah, it's not over when it's moved 10 ticks through the iceberg. It's over when it's moved 3 or 4 ticks through the iceberg. So the iceberg itself just gives you a make or break point, right? It's not just the one rule, but it gives you a make or break point. It's risk reward. That's why you want to watch it, right? Now, there are other things that give you a make or break point that aren't so obvious. So what you've got to ask yourself when you're looking at the absorption is, do I want to trade the most obvious thing that everybody can see? And it's fine if you do, but you just got to realize that if you're trading the most obvious thing that everybody can see, that's also something that people who manipulate the market and nudge the market around can also see. So a lot of people ask about icebergs. Virtually nobody says, how can I tell when the buyers no longer want to buy? Yeah, so the market moves up and we just run out of buyers. We run out of momentum, which is another thing you can spot, and it is significant, but it's the absence of something rather than a big meaty absorption level. right? So one of the things about absorption, you can trade them. They are good for risk reward because you know where the stop's just the other side of it. You can play the break or you can play the hold, right? But what you need to do is study which one really occurs more in each scenario. They might not be completely one directional, right? So you might find the iceberg holds, pops you up 4 ticks, and just because you come back down to that level, there might still be a bit of wiggle, right? So it's not like the market's only going to go one way after the iceberg held. And then the other thing, the important thing is in a trend and in a choppy market, the iceberg's going to work differently. And we had a chat earlier on, actually, we were talking about the same thing. So if you were at the point of control, let me just bring across another one. So for instance, in this scenario here, we can see we've got a lot of trade at 248.43, right? So if we came back to here and we cycled around and chopped around this area, and we built, a lot of volume here at, 44 or even 38, chances are when we get back to this area, we're going to churn at that price for a little bit. So you tend to see when you start rotating around an area, the point of control, the area with the most trade, you tend to stop and churn there. And in that case, the absorption might just be an opportunity to take a 1-tick scalp, right? To just kind of like, let's say you see 800 contracts bid and 300, 400, 500 contracts trade and there's still 800 bid. And you might say, well, that's churning because I'm at the point of control. So you put a bid in and you get to the further and further and further to the front of the queue until you get a fill. Now, if there's still 800 behind you because they've been refreshing at that level, then you've got a trade where you've bought the bid, you've effectively got a break-even trade. You can basically scratch the trade if the bids start to disappear, or you can scalp out on the other side, or you can hold for a run out. But if you're at the point of control, chances are it's going to just continue to rotate. So the chop, if you're in a choppy area, in the middle of a choppy area, it's going to do one thing. If you're at the edge of a small trading range, then the absorption is going to do a different thing. If you're in a trend and the market's moving up and you've got absorption on the offer side, chances are it's going to go through it. If you're in a trend and you're pulling back down and the iceberg's on the bid side, then there's a good chance it's going to hold, right? So you've got to take absorption in perspective in terms of whether the market's trending or not, and whether you're with the trend, against the trend, pull back, middle of a choppy range or extreme of a choppy range. And I would say, if you're looking at absorption, you're going to need to just watch your market and see how it tends to react in those areas. But again, mostly you're looking for that risk reward. The pops after absorption should be multi-tick trades. So if you're going to trade an absorption level, with trend, pullback absorption level, and you're taking the risk and getting out with a 1-tick trade, I think that's making a mistake, right? So if you do see this absorption, this iceberg, you should be getting a pop out of it, right? And I will just talk about, we'll go into the questions a little bit, but just talk about the correlations just a little bit. Because one of the other things you need to see with an iceberg, and this is a question a lot of people ask, especially the shorter term traders, right, is how do I know, if I'm scalping, how do I know whether to take more than a tick, right? And okay, so this is the market. This is the S&P, NASDAQ, Dow, right? So one of the things about correlated markets that kind of the more one-dimensional traders use, they want to use correlated markets because they want to see the direction, right? If you're a bit more sophisticated, what the correlated markets really tell you is the level of participation. So we know that there's arbitrage trading. So generally speaking, the Dow, the S&P and the NASDAQ will move together, and arbitrage trading will keep them in line. But there are times when the Dow will be up and the NASDAQ will be down and they're just kind of not going anywhere. And you'll find in those times the ES will be kind of sideways as well. So if you've got correlated markets, whatever you trade, if you're trading wheat and corn and other grains, whatever, if you've got good correlated markets, you're going to find the level of activity picks up in all of the markets at all the same time. That doesn't mean direction. I just mean level of activity, right? So first of all, the level of activity overall helps you kind of decide what kind of trade to get into and whether you're going to get more of a tick or you know, several ticks or, you know, points in a trade. So if you're in the middle of a trading range and on the ES and the Dow and the Nasdaq are not doing anything, then you're not going to get much out of a trade. But let's say you do get into a trade, and let's say you've got in on the bid on the S&P 500. Why don't you have an ATM strategy or an automatic exit strategy that gets out at one tick? And the reason is simply, if you're sitting here waiting to get filled on the bid, right, and then the Dow and the Nasdaq start to lift, and the ES hasn't lifted yet, hasn't started to move up yet, and then you get a fill, right? Then you get a fill, and the Dow and the Nasdaq are rising. Why would you get out with one tick, right? Because at that point, if the Dow and the Nasdaq are rising and the S&P hasn't gone up yet, the S&P just temporarily is, you know, theoretically speaking, it's undervalued, right? So basically, how do you know whether you get out, you know, can get more than one tick out of a scalp trade? Well, the answer is on the other markets. The other market should tell you if there's plenty of activity. The other market should tell you, you know, if they're generally rising up. So now again, that's not going to help the guys who are more swing day traders, but it's something to keep in mind, even as a swing day trader, when you get into a position, you know, maybe you're trying to get in on a limit order on at 91.50, for instance. That's where you think the market's going to turn, but you start to see the Dow and the Nasdaq liven up and start to lift. Well, maybe at that point you want to say, well, I'm not going to get 91.50, and I'm going to try and I'm just going to get into 92 because actually I think the level's already held. I'm not going to get a fill because I think everything's lifting. So that's really all I've got to say on absorption icebergs. Right, now I've got one question. Can we look at treasuries? Because he's saying it's very often the case that a lot of these setups only initiate moves of 1 or 2 ticks and then price stays there. Well, yeah, I would agree. And I would say if that's not the game you want to play, you shouldn't look at treasuries. So there's nothing really I can show you on treasuries. I mean, I'm not an expert, and John Grady is really the person to talk to. But there's not a lot I can show you on treasuries that will get you big moves. Unless you're looking at something like the ultra bonds. I think I've got the treasuries open. Okay. So we've got the ultra bonds here that have had, you know, a fairly decent day for their tick size. I mean, if I can just just make that a bit bigger, 60. Right, so, you know, it was a kind of wonder, you know, pretty much that was the move, basically. So there isn't really much on the treasuries. It is a very narrow range set of markets. It's very specific techniques, right? So it's really, a lot of people are scalping, you know, scalping the spread. A lot of people are spread trading, obviously. A lot of people are playing for a small amount of ticks. So you trade the treasuries if you don't like fast markets, if you like to have lots of time to make a decision, if you want to throw some size at the market and trade for a tick. But if you're trying to trade the treasuries with one contract to make $1,000 a day, it's just not the market, right? So I think I can't really, it's difficult to answer the question saying, you know, the treasuries don't give me any big trades and what can I do? And it's like, the only answer really is trade something else. So if you're a bit frustrated, I think the key, if you're in that situation, you've got some skills that work on the treasuries, I think you have to move up to a slightly more volatile market. Now you can look at things like the grains, the meats, stuff like that. Some great markets. Everybody goes for, you know, for the ES, but there's some good other markets that you can look at where there's a lot of games being played, and you maybe can move those skills across there. But like I say, I agree. But there are a lot of traders who trade for one tick, right? But if your account size and your boredom threshold, whatever, doesn't really lend itself to the treasuries, then I think you've got to move on, basically. Okay, so that's the questions on the emails. So let's go through the questions in the Q&A. So Al is asking, are Iceberg markers on Auction Vista now? They're not, but we will do that fairly soon. We're going to do that's one of the things we'll start in the new year. With AMP trading, are we allowed to use second logons for both CQG and Rhythmic without having to pay an extra CME fee? Not at the moment. But what we did today, we actually released a bridge from NinjaTrader 8 to DayTrader, which means you can have two trading platforms talking to each other. NinjaTrader hooks up to the data feed, and kind of DayTrader just kind of sits like a leech on top, just sucking the data out and pushing trades to NinjaTrader. So at the moment, that's only NinjaTrader. We are going to move that onto some of the other platforms. So if you're in this situation where you're paying for two data feeds and two sets of CME fees, we do have a solution coming for that. Now, how do you sell large trade size on resting paper? Well, that's kind of simple. Now, now, there's also Bookmap shows percentage of large trades in that comprises. Well, I don't really look at Bookmap, to be honest. So I don't really know what Bookmap does. We don't use percentages and stuff like that. I mean, if you want to see like the ratio of bids to offers, you can look here. So this kind of tells you which is in, which is dominant, right? So we can see here the offer side's dominant here, and here the bid side's dominant. So you can get that. You can also, if you want, look at the depth history. We can take that off. I need to, we can see the total there. Oh, well, that's messed up there. So we can see the total. That's not really that great a way to see it. The other way you can see it is with the meters, if I can find it, a depth power meter. So the depth power meter here gives you the total depth. You can actually set the number of levels because, you know, on a lot of markets, it's only the depth that's kind of close in that really matters. So I think this is looking at the first 5 levels. So you can see the first 5 levels here, 765 by 500. So it's not a percentage, but you can see the black lines here. These are at 12.5% increments. So you've got, this is 50% here. This is 62.5%, 75%. So there's a few ways to see the balance on the book. But to be honest, I've never really found a use for balance on the book. For me, I'm more interested in things from the order book, more interested in things like this, where we've got a lot of size here. These guys get out of the way pretty quickly. So the way that we tend to use order flow is more in terms of how much is trading at each side. Right, so you can see I'm traded 647 by 710. So we can see that's kind of pretty even. But as we trade up or down, what we're really most interested in how much traded. Not really that interested in how much is bid and offered. Now, I know there's this big sales pitch that like 90% of the trading information is the bids and offers, and it's absolutely true. So if you think about it, there's thousands and thousands of changes going on these bids here all the time, right? Compared to the number of trades, the number of trades is a minuscule amount of data compared to all of these changes here. But none of this stuff is relevant, right? So that went from 334, 335 back to 330. And to know all that information doesn't help you at all, right? It doesn't help you. But if it comes down here and trades 5,000 at 90.75, that's something you can trade off. So one of the things about these heat maps that are out, to sell a heat map, if the heat map is kind of like your big thing, to sell a heat map, you're going to have to talk up how much benefit it's going to be. So there's going to obviously be a lot of features that kind of that play on this thing, that the bids and the offers are the most important data. But really, if you think about it, the most important data is what you traded and things like where are people positioned. So you'll get a lot more information about where people's stops are than whether this bid's 666 and now 664, and it's changing up and down. It doesn't really give you a lot of information. We can do balance of the book. We can also do flip chart, which is a kind of slightly different way of looking at the book balance. It's basically looking at the snapshot information here. So you can see the snapshots bearish at the moment. And if they start to add on to the bids and pull from the offers, then that'll flip to bullish. So, and again, that information here is the same as this information here. So you can look at it, slice it and dice it in lots of different ways. But the end of the day, the most important information is how much traded. This 1,000 up here, it's like a heads up. It's just a heads up. It doesn't actually give you any actionable information, but it says when it gets up there, I'm going to keep my eye on that price, right? Now, there are markets like Crude if you take Crude in a fairly slow period, sometimes you'll see like 2 or 3 levels where you've got really high offers above. And what will happen, it will go up to that level, take those 3 offers out, and then just fall back down. Okay, and there are some people, market makers, who use those techniques, but just usually in quiet markets. But generally speaking, you want to be on the side of momentum. You want to be on the side of the trades. The bids and offers, I think, are great. But if you're going to look, probably 80% of the information that you're going to get, useful information, is the price and the trades, and probably at most 20% is the bids. So. Large size resting paper just means the limit orders, and yet there's lots and lots of different ways that you can see them. Right, what's a good market for a very small trader? Not the DAX. What I would say, if you're a very small trader, I would say your best bet is to watch the Euro futures or the Japanese yen futures and trade a small forex account, right? Because you can get well, you used to be able to. I've been telling people this for 6 years, and probably it's not true. Might not be true anymore. But it used to be with people like Oanda, you used to be able to trade for pennies, right? So you could like literally put a penny a point, a penny a pip, right? So if you're looking to get into this style of trading and you're not yet profitable, you could get a CFD account, you could get a forex account, and just pull up the Euro futures. I mean, it's just let's just see what's trading. Right, let's just see what's trading. Give me a second. God, I don't know how to use my own platform. Right. I'll try a 6E. Okay, so you can see the right there, 6E. That's obviously not the contract that's trading the most. That's strange. It does look very liquid, doesn't it? 6E. There you go. Okay, let's just see what we've traded today. So you could trade the Euro futures. You can see it's got a decent enough range, and you can trade a small forex account. And you're much better off doing that. If you're risking like $4 or $5, total on a trade, that's much better for you to much better off cutting your teeth doing that, and maybe losing like $100 a week or something like that, than trading sim or trying to trade the futures account. So I would say watch the futures on the forex futures, but trade the cash forex on a small account. Jack, your charts don't match the ones I see you have. I like yours better. We'll have a little screen share next week, Jack, and I'll sort that out. Right, what's the function of session manager in day trader and how to make use of it? It's very, very simple. Basically, it's just so you can set your start and end times. So if I look at CME, and I'll do CME indices, right? Can I open two? I can't open two. All right, I can only open one. Where do I click the right button? Oh, I can only open one. Right. So CME indices, what that is, it's giving me the start and end times of the contract. Now, you could say, well, there's no real pit for the CME indices now. Basically, there's still a whole bunch of traders that come into the market at 8:30 a.m. Central or 9:30 Eastern, which is when the stock market opens. But basically, the only reason you need this set up is that when it builds the volume profile, it's going to look at the session start time, to figure out how far to go back when building the volume profile. So if I chose just CME, in this case, it would go back to, Thursday today? It would go back to Wednesday, 5 p.m. But if I look at the indices one, this would actually just go back to today, 8:30 a.m. So it just looks at that and decides how to build the volume profile. Got no other use. Also, when you've got the tools open, it'll actually reset the volume profile when you get to that threshold. So it doesn't do much. Are there any plans to implement a trailing volume profile? Well, I don't know what that is, but if you can enlighten me by email, then I can certainly look at that. Is there a way to filter cumulative delta only to calculate orders above a certain size? Again, Michael, not really, not at the moment. But again, I can certainly entertain that concept if you're really interested in it. How do you use Jigsaw to gauge momentum strength? Right. Well, a lot of people ask for can I have a gauge for momentum, right? And that's a very often question answered, or very. I don't know what's happened to my English. It's a frequently asked question, right? So the momentum you see here, and if you want to see it, you can also see it if you take the filtering off the tape. Okay, so the momentum, this is what you're looking at momentum for. So momentum is this. And if you can't read the momentum there's not really going to be a gauge that can help you. Because if you can't pay attention to that moving over time, you're probably going to struggle with the gauge over time. But the closest thing to something that gauges momentum is simply the volume, right? Because if you have more, that's probably a bit, okay, it's 5 seconds. So if you have more trades per period, it means the momentum's picked up. So in a prop firm, they would be just using this area here to gauge momentum. So just turn that on, what most people are using. Here's the current trades. So most prop traders are just using this, watching the trades here to gauge momentum. Jigsaw customers tend to use this. You can use the volume as well. All that is momentum. You can use the tape, but it's really better off if you can just bite the bullet and actually just study these current trades and get to the point where you can tell really clearly if the market's speeding up or slowing down, because that's going to pay off the most than a gauge. How can I train myself to stop being a perma-fader? Well, James, should I concentrate on the cut and reverse drill? Well, that's interesting. I don't think the drill will stop you being a perma-fader. So a perma-fader is a term we coined at Jigsaw for people who try to buy the low of the day. And, you know, this concept of support and resistance. And what's happening is, obviously, if you're trying to buy the low of the day, what you're going to be doing is you're going to be watching the market move down, and you're going to be watching lots and lots of people selling that market as it moves down, quite happily selling it on the way down and making money out of it. And you're going to watch them sell it and sell it and sell it and sell it. And at some point, you're going to try and buy, and you're fading the market. Now, obviously, in a small range, then you're going to fade the market, right? But the problem with support and resistance is that for a market to hit support, it has to be moving down, right? It can't be moving, it doesn't move up to support. So for you to trade support, you have to buy a market that is moving down, right? Now, James, that no drill can stop you doing that, right? You have to get over the concept of it's too late to buy. You have to get over this kind of, there's this great, I heard one educator talk about, and a few I've heard it talk about, this concept of retail and wholesale prices. So basically, you know, the wholesale prices on this market would have been 84.75. So the smart traders paid wholesale prices. All these prices up here are retail. So like these 4,000 traders, and it's just nonsense, right? So what it's saying is that the bottom price was the professional wholesale price, and all the people buying 100 lots on the way up are all dumbasses, right? Now, the thing is, the market won't move up unless a significant amount of size trades on the buy side, right? It can't move up unless there's buying pressure, right? So this concept of support and resistance, of buying when the market's going down, you are buying when the market's going down, you are buying against momentum, and you'll find over and over again over the course of days, you'll try to buy the low and you'll miss it, and then you'll try again and you'll miss it, and it'll go down some more and it'll miss it, and it's going down some more and you'll miss it. And at some point it will just occur to you that when the market's going down, because you can see the market's going down. You've actually got the skill to tell that the market's moving down, and you've even got your eye on a target. Just sell it, right? If you can just make that, well, most people, if they could just make that one change in trading, it would make a huge difference, right? So you keep your support and resistance levels. I mean, I've got one guy I talked to a couple of weeks ago. He had this way of setting support and resistance levels. It was brilliant. It was absolutely fantastic. It was really good. He was losing money, but it was really good. It was more accurate than anything else I've ever seen. And it was really good, but he was losing money. So I said to him, right, instead of buying when it hits that price, just let it hit the price. Let everybody else do all the heavy lifting to turn the market around. And if the market does turn around from that point, then stalk a long trade. So you can buy it. You might miss a few ticks. You might miss 4 or 5 ticks off the low, but you're not going to be trading against momentum. So you've waited for that, that area to get hit. The market's lifted up away from that area, and now you can see you've got momentum to the upside. So start taking long trades, right? And so the drill, the cut and reversal, won't stop you doing that. It's a philosophical thing, right? You're trying to find the low. You're trying to buy the best price, and it's just not realistic, right? So lots and lots of trades. All you've got to do is watch the tape for a couple of hours. The S&P after the 9:30 open, and watch how many 100-lot trades go through when the market's moving up after it's reversed, and ask yourself, are they stupid? And the answer is they're probably smart, okay? Because all they're doing is they're going with momentum, right? Okay, I don't know if that makes sense, James. Right, Michael, I've been focusing on one trade, the high volume spike trade. Would love some type of audio alert when a bubble forms. I'm trying to watch it on gold and oil, but still miss the bubble from time to time. Michael, what I would say, I can do that, right? What I would say, though, it's kind of unrelated. If you're not profitable, I would go back to one market. So if you can't make money on one market, one trade, you will not make money on two, right? And you won't make money on two trades. You won't make money on two markets. So if you can just focus on one thing, and then once you can make money on one trade and one market, there's a whole bunch of things you can do to make more money, right? So you can scale up, right? You can skip trades to make more money. You can figure out a way to cut down some of your losers. You can apply it to a different market. But right now, for most people, I ask a lot of people, can you scale up? Can you scale up to make more money? And they say, no, I'm losing money. And I say, well, can you just make one trade work? And they go, why would one trade? And they want to be on a trade. They want to be able to see a trade all the time. They want to be able to go and open up a screen and say, right, what's the trade now? And instead of that, it's better off to just pick one trade. Pick something that happens 3 or 4 times an hour if you can, that gives you 7 or 8 ticks maybe on crude, and try and stick with that. And if you can make that work, then you can make it work somewhere else, and then you can make it somewhere else. But you'd have actually gone through the process of making something work. And that is a very valuable piece of education, right? But if you're trying to go through the process of making 5 things work and none of them are, and I'm being presumptuous here that's what you're doing, so I apologize if you're not. But I would say one market, and then your audio alert doesn't matter so much. But I will look at that because it's not very difficult for us to do. Tom saying, what I meant by trailing volume profile is that one would show the last 10,000 contracts traded. Okay, we could probably do that, yeah. I would still send me an email because it's Thursday night and it's just before Christmas. And, I'll be drinking eggnog. Right, so Drewski, prior to day trader version, there was a situation where the trade execution window could get lost. For example, when switching from an external monitor config to signal. It was difficult to retrieve. Does this happen with day trader? No, we don't have the same problems with setting up workspaces. So for the rest of you, the day trader app is the standalone app for Jigsaw, if you don't know. And before that, we had Rapid Trader and Profit Bench, 2 product names when we were in beta. And we had a few issues with workspaces where windows were just they'd fly off to where your 5th screen should be, or obviously where it thought your 5th screen should be, but it wasn't. And there'd be all kinds of issues. But now, Drew, if you were in the beta, most of that stuff, well, I haven't had any reports of that happening before, since we've had it in the live system, but it's been a while. Have had some people with some workspace issues, but most of those were looking at workspaces that were created in the beta trial. So all good. So I don't see any more questions. I'm just going to look in the chat. Some good comments in the chat. Thanks for answering. That's no problem. It's a Q&A. It's no problem at all. Heard it said that those that go against momentum are revenge traders. I don't think it's revenge trading, Jerry. I think what it is that that people come into trading, and there's all these websites and forums, and they're all very much geared around making a lot of ticks on a volatile instrument. And so, and that's what people want to hear. They want to hear that they can make $1,000 a day on a $5,000 account. Now, these websites, first of all, they don't really understand trading, right? So they can't tell people about scalping, or they can call it scalping, but they don't really know what it entails. They don't really know what it is. They don't really understand order flow. They don't really understand what the different kinds of institutional traders are. So they tend to go all along the same route. So it's all about finding a level that the market's going to turn around, right? And that's really, it's just drummed into us. Find a level, trade it. That's where the market's going to turn around. Or find a level, and then a lot of people come to us and they say, Pete, I'm nearly there with my trading, and I just need the order flow to confirm it. And I say, well, what are you doing? Oh, I'm trying to buy the low of the day. And I say, well, to be honest, you better just forget it, because order flow probably can't do that for you, because nobody can do that, right? Now, if you want to guess where the end of the day might be and see it lift up away from that, order flow can really, really help to make that profitable. It's just whether you can mentally adjust for getting in, at that little V at the bottom, or the little N at the top, and having your stop just the other side of that that low or high. So I think it's more we've just been drummed into retail traders that support and resistance. I mean, how many discussions are there on support and resistance on forums that actually talk about whether it's valid as opposed to how to find it? So almost every discussion on forums about support and resistance is about different ways to find it. And if you went onto a trading forum and said, well, support and resistance is nonsense, and put your argument there for that, they would all attack you. It'd be like saying your wife's ugly, right? Or your children are ugly. People would it's like you're attacking their very you're attacking their belief system. But it's just nobody's proved to me that support and resistance works. So I will question it. But I do think once you can look for areas in advance where traders might react, right? And if they do react, you jump on board. The lighter or white areas on Auction Vista are just areas where the bids or offers are thicker, right? So up here, it's above the price. So the offers are thicker up there. This recording it'll be somewhere for sure. It'll be on the YouTube channel. Keith asked in there. So do you think there's a value in seeing the delta of a time period bar? I do. I mean, if you look at, we're not moving here, but if you look at the Dow up here, these bars are green because the delta is green. So you got more buyers and sellers, right? So you're probably better off looking over a larger interval for that kind of thing. But yeah, I mean, you can see if the market's selling off. It's not something I really pay attention to be honest, but I can see that there might be some use in that. To know, this market's moving down because there's a lot more because there's more sellers and buyers, but it doesn't really give you the quantity, right? So you'd have to kind of gradient it. You'd have to have it like really bright, really red and really green, and have something in the middle, which is why the delta probably helps more, I think, because the delta kind of gives you more of a scale and more of an idea of how much selling. But yeah, the bars are green and red for buy and sell. Do I pay attention to it myself? No. Is it useless? I don't know, but it's just not something that I really pay attention to. I mean, maybe there were a lot more sellers in this area and we couldn't get through, and that's where we jumped up. But I think what I'd like to do, with any like conclusion like that, I'm doing like the CNBC thing, which is assigning cause to the effect. I've seen this, and I'm saying the red's there. So what I'd want to do is I'd want to really create a hypothesis of how to use it, and then go and look at the market and see whether that hypothesis is right, as opposed to just looking at history and seeing a pattern and saying, well, that pattern's, that pattern proves something. So I don't know. I don't know the answer. Preferred data feed. I will be shot if I say which data feeds I prefer. So I can't really do that. I use CQG. I also use IQ feed, right? I really don't think there's any much in it between them. I mean, one of the least accurate data feeds is Trading Technologies, because what it is with the feeds, right? They have to choose between accuracy and speed, right? Now CQG, I've asked CQG this before now. I've asked CQG, do you filter out any of the bid and offer updates? And they say no. And I'm like, no, it's not a bad thing, guys, if you do that. But I don't know how CQG do what they do, right? Because CQG are the only ones that manage to keep in lockstep and never lag and never print on the wrong side. TT will print on the wrong side quite often, right? So what happens is as you tick up, the trades feed, the level 1 feed, is saying one thing, but the bids and offers haven't caught up. So it kind of prints white or prints on the wrong side. So TT is from the ones you've mentioned there, CQG, Rhythmic and TT. TT is the least accurate, but it's also the one used by the most institutional traders, the ones that make the money. So it's probably not that important that every tick is reported on the same side. It's probably more important that overall you've got the right picture, and maybe TT traders do better because their feed's faster. Although I really don't know how CQG do what they do. The best feed would be one where they filtered out level 2. They filtered out level 2 messages, but kept level 1 and the inside bid and offer. That would be the premium feed, but nobody's really done that. But again, we don't really have many problems now. I don't know about you guys, but I don't really see many lags in the data nowadays at all. Well, probably really a dumb question. Interval is based on time. This is 30 seconds here. It uses really small intervals because we're looking at order flow. We're looking at things that happen at fairly small intervals. But the key with the intervals, people say, oh, using 30 seconds, I saw you using 20 seconds last week. Is 30 seconds the new magic? And it's like, no, I just want to see what happened this morning, right? And so I moved it to 30 so I see more history. So the only thing that I use from like the intraday chart is I want to see where it went and where it turned around. So I know where the high and the low was, and I know maybe this level here, you see the high here, and you look across and you've got these two circles, which was an area of absorption where there was a lot buying into the offers. That area was significant, and probably some reason. I would say the fact that we had a high here and the fact that there was a lot of trade there, I would say that's probably not a coincidence. That's probably related. So it's good to see where it's been and where it turned around. But I wouldn't ever ascribe any significance to individual price bars, ever. That would just seem weird to me. So the only thing I'm kind of interested in this. I'm interested in this area. I'm just interested in where the turns were. So I think with intervals, again, people can look for a magic interval, and I just don't think there is one. So I start off with, at the start of the day, a 5-second interval on the S&P, and then as we get further through the day, I can see I've got the open here. I mean, there's not been a lot of trade. So I can see as we get further through the day, I'll probably set it to, maybe up to 60 now. It's a bit later than I usually trade. So I now set it to 60 because then I can see the whole day, right? So there's not really a magic. So I think time frames, I wouldn't worry about them too much. And people say, can I use Jigsaw to trade the 1 minute? And I don't want to say, what are you talking about, trade the 1 minute? You just trade in the market. Literally, the market goes up and down. It doesn't go across, right? So I don't really, really bother about intervals much. Do I have any experience with e-signal data? Only the stocks data. We will do more with e-signal data later. For stocks, they're great, right? I've never used them for futures, so I can't really comment. Is there a way to backfill level 2 data for Jigsaw to review missed day? Not yet, but we are going to be working on that. We're going to be working on replay, and on-demand replay, not download it yourself replay. So once we've got the on-demand replay, we'll be able to backfill as well. Okay, so I've nearly... I've got some more questions on the chat. I'll answer a couple more questions, then we'll call it a day. Does Jigsaw plugin version also feature the new look and version of Auction Vista? The plugin version is going to disappear, right? And this day trader version you're looking at now will talk to the platform. So today we released an interface between day trader, this platform, and NinjaTrader. So what it does, it kind of piggybacks NinjaTrader and sucks the data from NinjaTrader and sends trades to it. I'm already talking to Tradeovate about doing the same thing. Now in Tradeovate's case, they actually write the software, so they wrote the interface between Jigsaw and they wrote the interface for the plugin. So I talked to the Tradeovate yesterday about this, and we had a chat that it's probably the way to go. I now need to show them the code so they can see what's different between what we've got and what they've got, and if they're okay with that, then we'll go ahead and we'll do the same thing with Tradeovate and other systems. NT7, I'm not sure what the lifetime is for Ninja. If Ninja have still got more than 12 months of life on it, then we'll probably do the NT7 version as well. If not, we'll leave NT7 on the plugin. So the kind of depends on Ninja. On the Vista chart, one last question. The price bar could be in green and red, although the price stays the same. Well, the thing is, the price can go sideways like here, but it's all red. But that could be like 10 sell market orders and 9 buy market orders, which is why looking at the balance is a bit misleading, because you don't know if it was a decent imbalance or a small imbalance. Now we could obviously do something there. We could make it percentage based, but I wouldn't read too much into it, to be honest. So for me, if they sell hard and if delta moves down but price doesn't move down, then like you can see here, the delta's moving down a bit. Price is flat, then that's a bit more significant, because it means people are trying to sell it and not getting anywhere. Okay, what I'm going to do is I'm going to leave it at that, guys. I would thank you. Somebody's asking for a momentum webinar. We'll do that, absolutely. Interface for other platforms will come. We're actually going to make it an open API, so we don't have to do the platforms ourselves. I would like to say thank you guys for coming, guys and girls. I would also say have a great holiday. If you celebrate Christmas, Merry Christmas. If you don't celebrate Christmas, Merry Christmas from me. I hope you have a good time whatever you're doing. I live in a country where they don't celebrate Christmas officially, but I've been hearing Christmas music since the start of November at Starbucks, and I'll be glad when it's over. So anyway, have a great Christmas, have a great New Year, and thank you all for coming. And if you've got any questions, there's a live chat on the website. You've got we've got email. There's lots of ways to get in touch with us. I'll just put my email in the chat. Peter Davis at jigsawtrading.com. Okay, guys. So thanks you all, and I will end the webinar. Thank you.